Good morning, everyone, and I'd like to welcome our NAB customers to this Business Insights webinar. My name is Jace Spiteri. I'm a Region Executive here at NAB, responsible for the Melbourne Southeast geography. I'd like to begin by acknowledging the traditional owners of the land on which we meet today. In Melbourne, that's the Wurundjeri people of the Kulin Nation, and pay my respects to their elders, past and present. I'd also like to acknowledge our Indigenous customers and colleagues who are present today. As you would be aware, the business landscape is a complex one with much volatility to navigate, both globally and locally. US tariff negotiations continue with a proposed deadline extended to August the 1st. The impact of these and any retaliatory tariffs is still somewhat unknown. And earlier this month, the Reserve Bank made the shock and unpopular call to keep interest rates on hold. To make sense of the uncertainty, the opportunities they may present to Australian business owners, we're extremely fortunate to have Sally Auld with us today. Sally's the NAB Group Chief Economist, and she's here to discuss recent events in global and local markets. We also have Jazz Ashton here. Jazz is our Executive for Markets and Trading Working Capital at NAB, and she's here to share how NAB is supporting our business customers to move forward and plan with confidence. We'll have some time to take your questions. So if you do have a question, please pop it into the chat and we'll endeavour to cover it through our conversation this morning. So perhaps to open, and I might direct this first one to you, Sally. US tariffs and President Trump's unpredictable approach to foreign policy is certain to keep markets on edge. Can you tell us what US tariffs will mean for the global and domestic economy? What will Australia's response be, if any? And what opportunity does the current landscape potentially present to Australian business owners?
Well, thanks very much, Joe, and good morning, everyone. It's a real pleasure to spend time with you this morning. So if we can just go to the next slide, please. I thought I would start by just giving everyone a sense of, where Australia sits in terms of what tariffs mean for us. And so you recall back on Liberation Day, we got hit with a 10% tariff across all our exports to the US. And I guess from the outset, if we think about this from a macroeconomics perspective, what's really important and what's really, I think, significant is that overall, we do not export that much to the US. Now, that's not to discount that at an industry or an individual firm level, a 10% tariff might not be a big deal, but from a macro perspective, it doesn't really move the needle very much. And that's just simply because Australian exports to the US are less than 5% of our overall export basket. So the tariff that's being imposed by the US is really only hitting a very small part of our export basket. You can see from that chart that the two biggest exports we send to the US are beef and gold. And really everything else, and there's quite a long list, but actually, the dollar value of what we send to the US is not particularly significant outside of beef and gold. So I guess the silver lining in all of this is that, our competitors in the beef space, so think about countries like, Argentina, New Zealand, Brazil, etc., they're all hit with a 10% tariff as well. Brazil potentially more, we'll see what happens. But from that perspective, at least the playing field remains reasonably level. So when we were thinking about the overall impact of tariffs in a direct sense on the Australian economy, basically the short answer is not very much. And so in that sense, our take on all of this is that other countries are going to be impacted more, and relatively speaking, I think Australia is in a pretty good position. Globally, if we could just go to the next slide, please. We have made some pretty significant changes to our forecasts to growth in many key economies over the last couple of months. And I guess, what we can see there is on the left is just a table showing, where these economies grew in 2024, what our forecast is at the moment for 2025. And then in the next column, we just have the change in that forecast relative to the prior month. And so actually it's been quite a tricky exercise putting these forecasts together, as you can imagine, because the playing field keeps changing, and it keeps changing because I guess US trade policy keeps changing and countries' response to that also changes as well. But in terms of total downgrades over the course of the year. The US is probably the biggest one. So, growth you saw last year was close to 3%. This year, we think it's going to be closer to 1.5%. So, almost that growth rate halving as a consequence of US trade policy. In Europe, pretty anemic growth, a little bit above 1%, similar for Japan, similar for the UK. Canada is one that is, quite significantly impacted from all of this. And China, we just recently actually revised up our forecast there, just simply because the economy seems to be doing a bit better in the first half of this year than we had anticipated. And of course, we did see the US and China reach some sort of agreement last month as well. So generally speaking, when we look, if you look at global growth for 2025, it comes in a little bit lower than 2024. But I guess importantly, global growth of 3.1 is still below trend growth. And so, I think we have to be mindful of the fact that, this is quite an uncertain environment, not just for people running businesses, but also for, people like myself trying to put forecasts down on paper, because none of us really have much lived experience, nor are there many historical periods where we can look back and see what happens to the global economy when you have a trade shock of this magnitude. So it's quite unprecedented. And so we have been saying to our customers, best endeavors to put forecasts down on paper, but we should acknowledge that there are wider than is usual bands of uncertainty around those forecasts. Or another way of saying that is that all the forecasts that we have at the moment have pretty fat tails. On the right, what we're really just basically showing is how the effective or the average tariff rate in the US has changed over the course of this year. So you can see it got pretty high on Liberation Day in early April. It's since come back down. And then we have a couple of dots at the end of the chart, which just sort of show us where we think we might settle if some of the headlines that we've seen over the past week or two actually are the starting point for the 1st of August. So that's the dark or the black dot there. And then if we add on what we think are going to be some of the sector-specific tariffs, so 25% on things like timber, semiconductors, 50% on copper, that effective tariff rate actually will go up again to somewhere close to 20%. And so you can see relative to where we were at the beginning of February before any of this happened, that's a significant increase. So the effective or the average tariff rate in the US was basically around sort of 3 to 4%, and we're potentially looking at something closer to 15 to 20. So that's a meaningful impost. And if we do settle somewhere near those black and blue dots, we will be making further downgrades to global growth. So I guess the message is the story is not yet over. Just to the next slide, please. I'm not going to go through this slide in a whole lot of detail, but what I did want to highlight is that while it is easy to get caught up in the headline noise around all the changes in tariffs, I think one way to think about what's going on is this concept of regime change, which is that we are, I think, and people know this on an intuitive sense, in a new regime at the moment. And so all the things that defined, I guess, the politics and the economics of the world that was very familiar to most of us, through the 1980s, the 90s, and the 2000s, have basically changed quite dramatically. And we're now in a world where, as you can see with that top dot point on the right-hand side, countries have turned inward, and economic security and national interest are basically driving effectively policy right across the board. And tariffs, we should just simply view as one version of what we would call economic statecraft. And this is about governments getting what they want for their country. So that's the world that we're in at the moment. Just finally, before I hand back to Joe, a quick comment on the Aussie dollar. If we just go to the next slide, you can see basically if we look at the performance of the Aussie through the course of 2025 or year to date, you can basically draw a gentle upward sloping line through that price action. So obviously there was a big dip around Liberation Day, didn't last for very long, but generally the broad direction of travel has been up for the Aussie, and we've been hanging around the mid 60s for the last little while. Our view at NAB is that the currency is going to continue to appreciate against the US dollar, and we have a forecast of 70 cents by the end of the year. We're not probably going to do so well on the cross rates, so we're not going to outperform against euro or sterling or yen, but we're reasonably confident that we are in a structural bear market for the US dollar. and that should see Aussie towards 70 cents by the end of the year, and then into the low 70s as we head into 2026. So I'll just pause there and hand back to Joe.
Thank you, Sally, and a lot to unpack there. And the implications of US tariffs have certainly been on the collective minds of our business customers. Yet, despite the uncertainty and the shifting economic landscape, there are signs of cautious optimism amongst our customers. We are seeing strong demand for business credit. Our latest NAB business survey indicates that business confidence is ticking higher. And our customers, who are a bellwether for the broader economy, are looking to leverage opportunities in market, particularly with a forecast of softening interest rates and consumer spending on the rebound. However, it is cash flow that's often cited by our business customers as their number one concern and critical to their ongoing growth. Sally, I might go to you first. Can you speak to our local GDP forecasts and how interest rates, consumer spending, and inflation may impact on this? And then Jazz, we might go to you, and if you can speak to how the NAB is supporting our business customers with their working capital requirements, particularly those customers with growth ambitions.
Absolutely. Thanks very much, Joe. So in a nutshell, we started the year with a forecast that the Australian economy would grow at 7%, at 2% this year. That's a little bit below trend, but better, definitely better than last year. And as the year has progressed, I guess two things have happened. One has been we've got a bit more less optimistic on the global growth backdrop. And the other thing that's happened is that the consumer or consumption was weaker than we expected in the first couple of quarters of 2025. And so that forecast for the Australian economy now sits at 1.75%. So we've made modest downgrades. When we look ahead into 2026, we think the economy is going to settle around a trend rate of growth of about 2.25. So what we really have from 24, 25, 26 is a gradual acceleration in GDP growth back to trend-like levels. And I guess what we've seen just recently is a sense that as we move through the middle period of the year, we are starting to see signs that the consumer appears to be doing a little bit better, which is really important. And also our latest NAB business survey for June started to show signs of life. So there is a sense that as we enter the second half of 2025, some of the key indicators around the underlying pulse of momentum in the economy have started to pick up, which is a really good thing. So we're looking to get back to trend growth in 2026, and we have a strong sense that the back half of this year is actually going to feel better than the first half of this year. So if we could just go, please, to the next slide. Just wanted to show you a quick slide on consumption, because consumption is about sort of 50-60% of GDP. So consumption is not firing, then broadly what you find, the economy is not doing so well. And what you see here, there are a lot of lines on that chart. The red line is actual household consumption, and those coloured lines are what the RBA's expectation has been for the consumption recovery at different times over the last couple of quarters. And I think the broad story here is that the RBA has probably been a little bit too optimistic on consumption in the last sort of 6 to 12 months. But as you can see, that red line looks like it's troughed for the cycle and is starting to head higher. It's not all one-way traffic, but generally we're expecting the consumer to do better in the back half, and that'll help the economy accelerate. So over to you, Jazz.
Thanks, Sally. Thanks, Joe. I mean, certainly from a customer perspective, it doesn't surprise me when customers are citing, working capital as being, their number one concern and critical to how they continue to grow. That's a lot of the conversations that we are having across the business, certainly with our business customers, how they look to manage their business. Working capital has always been very critical and important to them in terms of smoothing out seasonal fluctuations or their day-to-day sort of operations. But even more probably in the current environment, we're seeing our customers are focused on how they utilise trade and working capital facilities to help them better manage or reduce costs. And that can improve their bargaining power with suppliers. They're able to secure better terms with either suppliers and or their debtors, and as well as helping them sort of access new markets or customers in the market. Only recently, we were helping a customer in Victoria, manufacturing customer, who recognised that their sales were slowing in a market that was actually had growth opportunity. And this was because their customers had downgraded in terms of their price point, the end price point for their products. And so in helping them review their supply chain and shifting to a supplier in Asia rather than traditionally in Europe, they were actually able to reduce their costs and target that lower price point, which meant they could open up a market, a customer market that they hadn't previously been able to penetrate. And so that really assisted them. It gave them confidence with a trade facility that we provided them to negotiate better terms and better prices with their supplier, and absolutely gave them that confidence in terms of being able to deliver that. It also gave them the ability to manage their control, and we could do that through our trade facility. And that helped them reduce their costs and manage the quality of the products being shipped. So, there's certainly, we're seeing this thematic around customers looking to diversify, whether that be through expanding into new geographical markets, diversifying their suppliers, or trying to penetrate markets they haven't been penetrated. And I think that's where that, cautious optimism comes into it, but how they utilise some of these working capital facilities to really help build confidence, unlock that growth potential, and help them manage their cost in their business has been, really critical for many of our customers. Thanks, Joe.
Thanks very much, Jazz. So just on to the next slide where we talk about the outlook for interest rates. As Joe mentioned in his introduction, the RBA surprised the market and a lot of economists, including ourselves, who thought they would deliver a 25 basis point rate cut in July. But as the governor said, it was less about the direction of rates and more about the timing of rates. And when we read the Reserve Bank board minutes from that July board meeting yesterday, I think what comes through very clearly is that the bank faced into a lot of uncertainty at that meeting. So uncertainty around the global backdrop, uncertainty around the labour market, because prior to the last set of employment numbers, we did have an unemployment rate that had consistently printed at 4.1 for the last 5 months, and on the Reserve Bank's models at least, that in their interpretation reflects quite a tight labour market. So they had uncertainty around whether that had the potential to generate further wage increases, uncertainty around the inflation outlook, which was a little bit of a change from them, and then of course uncertainty around the consumption outlook as well. And so effectively they took the view that the next meeting was only another 5 weeks away. By the time that rolled around, they'd have more information on inflation, more information on the labour market, a little bit more information on consumption, and of course, a bit more information on the ultimate tariff regime. And therefore, there was a good, what we would call, or a significant option value in just holding for 5 weeks and waiting for that information to come in. So we haven't changed our end point where we think the cash rate will settle. Our broad view on monetary policy is that if growth is going to be at trend next year and inflation is going to be back in the target band and sustainably around that 2.5% level, then in that sort of environment, what you want is a setting of monetary policy that is broadly neutral. So you don't want monetary policy to be expansionary, but nor do you want it to be contractionary. And I guess the big issue and the big sort of difficulty for forecasters is working out, what cash rate is basically sympathetic with this notion of neutral monetary policy. On our analysis, that cash rate is a little bit above 3%. And so what that means is we do think the Reserve Bank's got scope to cut rates 3 more times over the next 6 to 9 months. And so we think they're going to cut by 25 basis points in August, in November, and then in February next year. And that will take the cash rate to 3.1%, which is broadly consistent with neutral monetary policy. So that's the outlook. The governor is actually speaking at a lunch later on today, so we might get a little bit more information around the way the bank is seeing things. But I guess the message from certainly the July meeting and the minutes that we saw yesterday was that the bank wants to move in a gradual fashion, but also in a cautious fashion as well. And some of that caution, I think, just exists around this notion that potentially not quite sure where the neutral cash rate is, and they seem to have I guess, an underlying anxiety perhaps lurking somewhere that they don't want to take rates too low. And so the reason for that is just simply that they feel like they've done a really good job and they should indeed be congratulated for getting inflation down without pushing the unemployment rate up. And they don't want to threaten, I guess, that outcome too much. So just one more slide before I hand back to Joe. Just wanted to talk a little bit about the inflation outlook. You can see it here. This is the trimmed mean, or the core measure of inflation. So this is the measure that the Reserve Bank focuses on. It's the measure that abstracts from some of the quarter-to-quarter volatility that we see in inflation. And that's the one when we talk about that 2.5% midpoint of the target band, where we really want core inflation to settle. So you can see, what a challenge the last couple of years have been. Core inflation spiked up to 7%. The bank had to work pretty hard to get it back down. But on our forecast, which is the little red line you can see on that chart, we do think that inflation is going to continue to decelerate, and it should be settling somewhere around that 2.5% level in the next couple of quarters. And our forecasts are actually just a touch below where the Reserve Bank forecast is. So we probably don't share the same underlying anxiety around inflation that the Reserve Bank does, but we will get the next update next week, next Wednesday, and that'll be, I think, pretty critical for giving the Reserve Bank just that additional comfort that actually everything is okay with inflation, and that does open the door for some more rate cuts. So back to you, Joe.
Thank you, Jazz and Sally. Some positive news for our business customers, with GDP growth forecast to revert to trend over the next 18 months or so. Working capital needs aside, some of the concerns of Australian business owners have been sourcing skilled labour, wage price increases, and other rising input costs. Our customers are telling us that this is putting a squeeze on margins, and they've been unable to pass those costs in full to their client base. Many Australian businesses have had to innovate and adapt and build greater efficiencies or lift productivity. And as a result, more SMEs are turning to technology, automation, and leveraging AI as a potential solution to these challenges. Sally, can I get you to talk to the employment numbers and perhaps migration and housing trends here in Australia, as we know they are a key driver of our local labour force? But can you also talk to how SMEs are responding into the current landscape with their CapEx intentions?
Absolutely. Thanks very much, Joe. So if we could just move on to the next slide, please. So this one just basically shows Australian GDP. So like I said, our line there, our forecast is the red line, not dissimilar to what the Reserve Bank has in their trajectory, although we think the acceleration might be just a touch slower than they have in their numbers. But effectively, the story is the same, which is that the worst is now behind us for GDP growth, and we do think that things will get gradually better over the next couple of quarters, and we get back to that trend rate of growth in 2026. Onto the labour market. So if we could just go to the next slide, please. Effectively, we have the unemployment rate peaking at 4.4% for this cycle before settling back towards 4.25%. 4.25% is our estimate of what full employment looks like in the labour market. And so you can see that black line, which is the actual unemployment rate, got pretty low in the aftermath of the pandemic, so around 3.5%. It's been gradually tracking higher over the last couple of years. It's settled in the low fours. Right now, it's at 4.3%, so not too far from where we think it's going to settle. But basically, as you can see from that chart, settling in the low fours, somewhere between 4.5, is historically still a very low unemployment rate. So unemployment rate tends to be a really lagging indicator. So it's almost like the last thing to move. And so what we're seeing is that gradual little uptick we have in our numbers, reflecting the softness in the economy in 24 and the first half of 25. But broadly speaking, we think this is going to be a labour market that's nicely in balance. Just to the next slide. Couple other things on the labour market. So wages growth, you can see there on the left-hand side, that shot higher in the aftermath of the pandemic when, as many of you would, I'm sure, know, through experience, we had a really tight labour market and employers had to really pay up to get staff. And so wages growth sort of went from very low levels of just a bit over 1 to very high levels, a little bit over 4. It's since cooled and has come back to something closer to 3.25%. That's fine if we have productivity growth. So the way basically the sort of mass of the economics work is that if you want inflation to be at 2.5% on a sustainable fashion over the cycle, you can run wages growth at 3.5%, assuming you have productivity growth of 1%. And at the moment, we don't have 1% productivity growth, as Joe mentioned. And so we can probably withstand wages growth of 3 thereabouts in the short run, but that is not going to be sustainable unless we start to get the lift in productivity growth going forward. On to the next couple of slides. I think these are quite interesting because they do give us a sense of some of the population dynamics at the moment and the demographics. Effectively, if you have a look at the chart on the left, we've got 2 measures of the population. We've basically got the actual number is the red line, and you can see what happened through the pandemic. It sort of stopped growing and we've since recovered pretty quickly. But the grey line below shows you the year-on-year rate of population growth. So it dipped to almost 0 during the pandemic, but it popped higher to 3%, which is historically an extremely elevated level of population growth in the wake of the pandemic, and has now come back to 2%, which is a little bit higher than where we settled pre-pandemic, but probably a little bit more manageable. And you can see on the right-hand side, where the population sort of growth comes from in terms of net migration. A lot of it in terms of visa holders is being driven in particular by student visas. The next slide, if we could just move to that, just gives you a sense of how this has played out across the country. And so what we're looking at on the left-hand side is just population growth in different parts of Australia. So you can see, really there are, I guess, sort of 3 or 4 regions that are growing well above average. So WA, Greater Melbourne, Greater Sydney, and then also Queensland. So it's really sort of New South Wales, Queensland, and Western Australia that are doing the bulk of the population growth. And then what I think is quite interesting, what we're looking at on the right-hand side of this slide is basically the deviation from the pre-pandemic trend. So what we're really saying is what parts of the country have done exceptionally well or not so well relative to what the trend would have predicted if we use that trend pre-pandemic. And what we find is places like Queensland, South Australia, and WA have actually done very well. And basically Victoria, and in particular Greater Melbourne, have been the real losers in terms of that intrastate migration. So some interesting insights from that chart. And just finally, just to talk a little bit about CapEx intentions and what we're seeing from businesses in our NAB business survey. What you can see, what we've got here is business confidence and business conditions. Neither of those series have looked that inspiring over the last sort of 6 to 12 months, particularly business conditions, which have been on a really clear downward trend for the last couple of years, and business confidence, which has sort of hung around below average for the last couple of years as well. But as I mentioned earlier, what we can see is just in the last survey for June, both of those measures have popped higher, and that's encouraging. And our survey also reflects, we also ask questions on things like profitability, things like employment intentions, things like CapEx intentions, capacity utilization. And so the good news that we see reflected in the latest reading for conditions and confidence was actually also reflected in many of the other parts of the survey as well. So when we look at what our customers are telling us that they intend to do on CapEx, the story there was a pretty positive one as well. And I think for an economy where, generally speaking, we would argue that there hasn't been enough investment in the capital stock in Australia, and that's, I think, been one of the drivers, not the only driver, but one of the drivers of the low productivity story. If we can really sustain a sense that businesses are wanting to invest more in CapEx, I do think that opens up the possibility for a more optimistic outlook on productivity growth over the medium term. So on that note, I'll hand back to you, Joe.
Thank you, Sally. And here at NAB, we are starting to see some increased demand for new plant and equipment, particularly from those customers who are looking to accelerate the scale up of their business, lower unit costs, and improve their economies of scale. So I did suggest that we have some time for Q&A, and we do now have some time for your questions. So a reminder that if you do have a question, please pop it into the chat. Our first question is on the Aussie dollar. We know the fluctuations in currency do impact our business customers in terms of how they forward plan and budget. And Jazz, I might direct this question to you. How does the NAB protect our customers from currency risk, and how can the importers on this call potentially participate in any rally?
Sure. Thanks. Great question. I think well certainly the AUD has rallied 66 cents overnight against the USD, and this is the highest level we've seen since November 2024, which is a prime opportunity, obviously, for importers to be having discussions, with FX risk advisors. By and large, if the AUD continues to rally, as our economists forecast, as Sally forecasting, we'll be in a very positive position for importers. But we certainly don't recommend that they sit on the sidelines and completely unhedged and wait for that rally. And we always know things can change quickly in terms of currency and what can happen. So having some level of protection, and what we're probably seeing is that many importers are using sort of forward contracts, but also now some are considering and using some currency options where you can get protection on the downside, but continue to take advantage of the upside in terms of the rally. So again, I think we've got a great team of FX specialists who can absolutely help look at your business situation and talk about risk management strategies and how to help protect those strategies. So absolutely reach out is probably the key message I'd love to leave everyone with.
Thanks, Jazz. And we do have a question here around cost of living pressures and housing pressures. And Sally, I might direct this one to you. Cost of living has been a reality for many Australians. Are we seeing signs that cost pressures will start to ease going forward?
Yeah, that's a great question. Thanks, Joe. Absolutely. When I guess we just think back to that chart on inflation, we had such a rapid lift in inflation, and as a broad measure of cost of living, the real issue for all Australians was basically that people's incomes or their wages weren't rising at the same rate. And so, the value of what your pay packet could buy each week or each month, was shrinking as the prices of everything that we spend our incomes on were going up much faster. And so that's been what we would call a hit to real incomes. And it's one that lasted a couple of years. And, one of the reasons why we are cautiously optimistic on the consumer and consumption, but not sort of unbridled optimism, is simply because what we observe in our own internal data at NAB is a sense that households, after that couple of years of hit to real incomes, want to repair balance sheets. And so we're actually seeing household deposit growth lift quite significantly. We're seeing people want to pay down debt more quickly. So as interest rates come down, we're not actually seeing very many mortgage customers want to reset their mortgage payments. They want to use that opportunity to pay down the principal. And so it does tell us that the scarring from that period of negative real incomes growth, I think is maybe persisting for a little bit longer than perhaps we anticipated. Going forward, if the Reserve Bank, is successful in its ambition, to keep inflation at 2.5% in a sustainable fashion, what we should start to see is some of the shock around the price level, so the level of things, dissipate. So prices are still going up, but they should only go up at 2.5% a year as opposed to 6 or 7% a year. And as incomes growth goes up, at the moment wages is running a little bit above 3. We are going to start rebuilding that gap between wages growth accelerating more than inflation, and that should help to ease cost of living pressures. But as I said before, the key to sustaining that gap is basically productivity growth. And that's why, I think it's really important, as the government signaled, that, the focus of this term of government is really about doing something on productivity. That's how we lift our standard of living over the next little while. Housing is a different issue, and we have a structural or a chronic undersupply of housing. That's not something that we can fix overnight because, as we know, it takes time to build houses and it takes time to build a lot of houses. And so the government, not to most people's surprise, but the government has said they're not going to hit their target of 1.2 million houses over 5 years. I think most people always felt that was pretty ambitious. But we are going to have to live with that shortage, for a while yet. And I think the housing affordability issue is only one that's going to take. This is not something we can solve in the next couple of years. I think, and it might be a bit sort of shocking to hear this, but I do think this is going to take almost a generation to fix. And it's probably going to take us that long to lift the supply of housing. And it's probably also going to take us that long. We need a period where household incomes rise at rates that are higher than the rate of growth of house prices in order to bring that sort of price to income ratio back to something that is more affordable for the average Australian. And again, that's not going to happen overnight, but it will happen if we manage to do something on the supply side.
Thank you, Sally. We might have time for one more question, and I might go back to you, Sally. What economic indicators should business owners on this call keep a lookout for in coming weeks and months? What risks could shift our forecasts?
Great question. It's always good to be mindful of the risk. So, I think at the moment when I look at our forecasts that we have at NAB on growth and inflation and the labour market, I feel like they look broadly balanced. I don't think we've got sort of asymmetric risks. So we're not more worried about the upside or the downside in one direction. I do think, the one thing that I am mindful of is, I guess, just what's going on in financial markets. And, as we talked about at the beginning of the webinar, we're probably looking at a shift in the tariff regime in the US, which is really significant. And one simple way to think about tariffs is that it's a tax. Ultimately, someone has to pay that tax. It might be the final consumer, it might be the importer, it might be someone else. But ultimately, if you take that effective tariff rate up by 15, 20 percentage points, that's a significant tax increase for the US economy. And so we are staring down the barrel of a US economy that's going to slow, I think, quite sharply in the back half of this year relative to the first half. And yet we've got equity markets, sitting at all-time highs, valuations in those markets that look really elevated relative to the long run. And so I do feel like there is perhaps a little bit of vulnerability in perhaps financial markets. And so if we did get a meaningful adjustment there, that has the potential to ricochet into the real economy and maybe just sort of amplify some of the effects of tariffs. And so I think, from that perspective, less worried about the Australian outlook, maybe a little bit more worried about the global outlook. But I do think Australia is relatively well placed to withstand all of this. And, we do have scope to cut rates by more if things get a little bit more worrying offshore. We do have a government that has, relatively speaking, a respectable fiscal position. So it does have scope to ease fiscal policy if the going gets rough. And so we've got plenty of channels through which we can support the broader economy. And so for that reason, not so worried about downside risk to the Australian economy in the short run. When I do worry about the Australian economy, it's really all about the medium-term outlook and, what we need to do around productivity and housing in particular, and also energy policy. And I think if we can sort those three things out, this country would be set up pretty well to have a good couple of decades. But in the short run, the things that we'll be watching closely will be consumption, it'll be the labour market, and it'll just be keeping half an eye on inflation just to check that it is actually going to be as benign as we think going forward.
Thank you, Sally. And Jaz, I might hand over to you to share some of the resources that NAB makes available to its customers.
Fantastic. Thank you so much. And thank you, Joe. Thank you, Sally. It's a great conversation, and one that I absolutely hope has helped you and your business in terms of understanding the current economic landscape, both here and globally, and helping you think about the decisions within your business. I think the key message, we are here to help. NAB is absolutely wanting to support its customers and continue to speak to us, whether that be your banker or your specialist, to help you, whether that's looking to unlock working capital, look at next opportunity for growth, or how you continue to manage your costs or diversify your risks across your business. We absolutely want to help. So some of the great resources we have here. We have my favourite, the NAB Morning Call podcast, which is a great 15-minute update every day to give you in the morning a very quick snapshot of what has happened globally overnight. We have our business research and insights on nab.com.au/insights, which you can get all the various pieces of economic and business updates, insights that we produce. So please check that out. And also our global markets research. So absolutely subscribe to that for any of the content you wish to get. We will send you a link to this webinar, and presentation will be emailed to you. It has been recorded, so please do, if there's any insights you want to re-watch, please do. And we thank you so much for joining us, and hope this has been a relevant and very insightful session for you all. Have a lovely day.